Guys, inflation is where a slow burning flame is literally burning away your cash, and we don't talk about it because it's never been an issue for us millennials. For around 40 years in most developed economies around the world, inflation has been in control. For many of us, that's more than our entire lives, and at the very least, our entire earning lives.
Why are you laughing?
I really wanted to understand how to make better investment decisions, as it has become clear that inflation is very likely to return as a more constant in the world, and why my daily essentials like milk and bread might go up by say 10 pence every year.
Back rolls.
So inflation is a dry topic, I know, but so important to understand as it makes us value personal finance and why investing is so important. So let me try and spice it up a little bit. Inflation is basically the rate at which prices increase every year, and inflation out of control is a problem, especially as all things don't move in unison. For instance, often as employees we negotiate our salaries, but we don't always get a yearly increase in line with inflation. However, the world around us has got more expensive. So without an inflation-linked increase, we're effectively getting poorer each year because our money buys less. However, we do want controlled inflation. It shows our economy is growing and demand for products and services increasing. The opposite though, deflation, is what we have been fearing for so long, and that's when prices drop. This is a sign that demand is dampening and consumers are not spending and growth is slowing, and that's not great for the economy either, as what follows are job losses and output reduction. Now, over the past year, we have been living through a pandemic where output has been lower, but now as the pandemic is showing signs of coming to an end, markets are waking up to a great post-pandemic bounce. Governments have gone nuts in printing money, and so with all this demand and easy money which can be borrowed at record low interest rates, the threat of inflation being higher is a real issue for investors. Particularly those who are holding cash, which isn't investing by the way, or holding assets for an income, as those tend to be less linked with the growth of the economy, like stocks for instance. Or is it actually? See, that's what I thought. Being an early 30s millennial, I don't need to worry too much about inflation and just keep investing in equities. But then I received comments like this that got me thinking, I don't know this stuff as well as I think I do. So I found a paper by a strategist at Schroders, a well-established and highly respected fund management company. And no, I don't mean this guy. Anyway, the chap at Schroders is Sean Markowitz. I think I'm pronouncing that correctly. And he's actually on YouTube too. So Schroders have a YouTube channel, if you didn't know, where he presents. And this is kind of a hidden gem on YouTube. So go check it out. But let's sprinkle the facts, guys. Sean studied data going back to 1973 on 7 asset classes to see how they perform through an inflationary environment. These are, let's see if I can list these off: US treasuries, like government bonds, US stocks, cash on short-term deposits, property and REITs, inflation-linked bonds, gold, and finally commodities.
It was therapeutic for me. I don't regret it.
So yes, it would be obvious that bonds which pay a fixed interest would be sensitive to inflation, thinking out loud that is, because as prices in the economy go up, i.e. inflation, your return from bond interest is not worth as much as you would sell them for better investments. So in a nutshell, inflation goes up, bond prices go down, reaching a point where yields rise to an acceptable level again. Does that make sense? No? Well, just hang on in there. And where I was actually surprised was that equities were the next worst inflation hedge. Kind of goes against what I was saying earlier, where companies can pass on inflation to customers. But the reality of it is that it's not always that simple. Inflation matters to investors when they assess stock markets. And the study found that 3% was a critical number. So when inflation rises above 3%, investors become less willing to hold stocks and pay up for the future earning. Thereby, those PE ratios fall and the market corrects itself. So in summary, low controlled inflation is good, high inflation not so good. Now the Schroders website has Sean's article incomplete, though this table here is actually really good at illustrating the point, and I really like it because it provides 4 scenarios and the likely probability of returns beating inflation. The first one is low rising inflation, high and rising inflation, thirdly high and falling inflation, and fourth low and falling inflation. Now as our interests are in investing and following the pulse of the economy, we can prepare ourselves for the ride to come and also remind ourselves of the investment horizon and plan. Right now, I feel we're somewhat between the top 2 rows. and eventually moving to the second row. But what the table does show us, and I was surprised to learn this, is that REITs and properties relationship with inflation is less clear. Yes, I agree, it tends to perform better when inflation is falling, but regardless of inflation scenarios, it always has this odd chance of beating inflation but performing worse in high and rising inflation. So for us, investing or having a REITs in our portfolio always makes sense. So this graph is also really useful in the two inflation scenarios. The first bar of each asset class shows a low but positive inflation rate, and that is controlled. The second, a high and also rising inflation rate. So we can clearly see that if the purpose is to protect our capital in high inflation environments, that is, equities don't really make good investments, and neither do bonds, but they do a better job at riding inflation than equities. Stand out as inflation hedge are commodities and gold when inflation is high. All hail gold, and digital gold these days too, I suppose, Bitcoin and all that jazz. So what does all of this mean for us investors who just want to keep it simple and kiss and make better decisions? Well, if your objective is protecting capital because you're approaching retirement, then you'll know balance. Having commodities and gold, fixed income and equities all make sense, and finding that right allocation is key, something to get financial advice on. For me, well, at the moment, I'm split between real estate and stock and will continue to buy both. I had a look at my splits and I'm about 50-50 between the two, and based on the data we discussed, that should ride out the inflation. Getting a grasp on inflation is important, but investing consistently is also super important. So I've got a video here which explains some simple steps to investing and personal finance, which should help in reducing your time to retirement. I don't know about you, but I want to be done by 40. So these bunch of videos covers that. And I've also added a couple more videos on inflation if you want to get your head around how inflation is important and can impact your savings. So here it is, and I'll see you over there.